Welcome to the Deep Dive, where we cut through the noise and get straight to the crucial insights you need to be truly well-informed. Today, we're plunging into a really comprehensive report titled Banking Compliance, Tech, People, Data. Now, you might be thinking, compliance, is that really a deep dive? And to that, I say, absolutely. Regional banking is at, well, a critical juncture. It's facing these unprecedented pressures that are fundamentally reshaping risk and regulation. It really is a crucible, a severe test that's demanding transformation.
It really is. And what's fascinating here is that the traditional ways of doing things, those siloed compliance models, they're not just inefficient anymore. They are, frankly, obsolete. Our mission today really is to unpack how banks can transform compliance. Move it from being seen as this reactive cost center into something proactive, integrated, something that actually drives resilience and maybe, surprisingly, competitive advantage.
That's the core of it, isn't it? We're talking about these three interconnected pillars: people, operations, and the data ecosystem. And here's the kicker, right? A failure in just one of these inevitably cascades. It impacts all of them. So get ready for some, I think, surprising facts, some practical applications of AI we'll get into, and definitely some actionable insights that'll help you understand this vital topic. Let's start unpacking. Okay, so this idea of a compliance crucible. It's powerful metaphor. What are the real forces heating things up for regional banks right now? Is it truly as existential as it sounds?
Oh, absolutely. It really is. If we sort of connect this to the bigger picture, what we're seeing is a perfect storm, really. A confluence of accelerating trends that the executive summary highlights. You've got rapid digitalization completely reshaping how banking happens. Then there's heightened geopolitical volatility, creating entirely new risks, a much more intensified focus on consumer protection from regulators, and of course, the rising importance of ESG factors, environmental, social, and governance considerations. The report makes it abundantly clear, just reacting, that posture is no longer viable for a regional bank. It's not just about avoiding fines anymore. It's a direct threat to their solvency, their reputation, and frankly, their very viability in the long term. This isn't just change. It's a fundamental reshaping of the entire landscape.
That's a stark warning. And these aren't just abstract ideas floating around, right? Each one of these forces translates into very specific, very urgent challenges that banks are facing, day to day. Let's really drill down into that new compliance paradigm. First up, digital transformation. It feels like we've been talking about digital banking for years, but what's newly impactful about its role in compliance right now?
Yeah, digital innovation is definitely the primary catalyst. It's relentless. It's ever-present. The sheer proliferation of digital banking services, the rise of these agile fintech competitors, the surge in cross-border digital transactions, it all means regulators worldwide are constantly playing catch-up. They're introducing more stringent, more sophisticated rules at a pace we haven't really seen before. And this digital shift, it isn't just about offering convenience to customers. It creates entirely new risk vectors. We're talking everything from complex cybersecurity vulnerabilities that, frankly, legacy systems just struggle with, to really novel forms of financial crime that simply didn't exist a decade ago. It's a whole new battlefield.
A whole new battlefield. And this next challenge you mentioned, geopolitical risk, that really surprised me when I first read about it in this context. How does something as broad as global instability translate into an operational driver for compliance, especially for, a regional bank?
It's a fascinating point, and it's becoming increasingly critical. Global instability has really shifted. It's gone from being a background concern, something maybe for the economics team to forecast, to an immediate hands-on operational trigger for the compliance functions. Think about the war in Ukraine or the shifting trade dynamics with China. Sanctions are now a primary tool of foreign policy, not just some rare measure. The report highlights a startling statistic here. Their frequency of use has reportedly increased 1,000-fold over the last decade.
1,000-fold, wow.
Yeah, it's huge. And this places financial institutions directly on the front lines. If a sanctions list changes in, say, Washington or Brussels, a regional bank needs an immediate, verifiable response within its transaction screening and monitoring systems right now. That directly tests the institution's IT and operational agility. It transforms geopolitics from some macroeconomic discussion into an urgent, real-time IT and compliance challenge for the people actually doing the work on the ground.
Wow, 1,000-fold increase. That's not just astonishing. It's a whole new level of pressure.
Yeah.
And it's not just global forces, is it? There's also an intensified focus on consumer protection right here at home. The Consumer Financial Protection Bureau, the CFPB, that's a name most people probably recognize. What are their priorities right now, and what does that really mean for banks day to day?
Right. The CFPB has truly sharpened its focus. They're really zeroing in on ensuring fair consumer outcomes, transparency, and eliminating what they see as predatory practices. This has led to a wave of new rules and, frankly, increasingly aggressive enforcement actions, especially around things like overdraft fees, other fees they call junk fees, deceptive marketing practices, and ensuring real clarity of disclosures, particularly in lending products. Their goal is pretty straightforward. Safeguard consumers, make sure they can make informed financial decisions, and prevent unfair treatment. For banks, this means they have to, well, reevaluate pretty much everything, their product design, their marketing materials, all the customer communication protocols from the ground up, really, to truly bake in fairness and transparency right from the very start.
Baking it in, not just bolting it on later. Makes sense. And then there's ESG and climate risk. You mentioned this move from being sort of a niche discussion to a mainstream regulatory priority. What exactly are regulators expecting from banks in this area now? It feels complex.
It is complex, and you're right, it's moved rapidly. ESG considerations, especially climate risk, are no longer voluntary or just, good PR. Regulators are increasingly mandating that financial institutions assess, manage, and disclose their exposure to climate-related financial risks. And this isn't just about a bank's own direct carbon footprint, although that's part of it. Critically, it includes the climate risks embedded within their loan portfolios. Think about loans to industries heavily impacted by climate change, or those contributing significantly to emissions. The expectation now is for transparent reporting on ESG metrics and increasingly aligning lending strategies with broader sustainability goals. It adds a significant, complex new dimension to traditional risk management and compliance reporting.
Okay, so putting this all together, digital transformation, geopolitical risk, consumer protection, ESG. You said earlier, these forces don't operate in isolation. How do they actually intersect? And what's the consequence if a bank has a weakness in, say, just one area?
That raises a really important question. How do you manage this complex system where everything is interconnected? The fundamental insight here, I think, is that for banks today, compliance isn't a series of isolated checks anymore. It's like a single interconnected nervous system. A bank's digital transformation, for instance, directly intersects with stringent data privacy rules and the absolute necessity of cybersecurity resilience mandates, the AI models they might use to enhance digital services. They're simultaneously subject to intense, fair lending scrutiny to prevent bias. This convergence means that a weakness in one area can, and often does, trigger a cascade of failures across multiple compliance domains. What might seem like a minor hiccup in one spot can now potentially cause a full-blown systemic shutdown. So holistic isn't just jargon anymore. It really is your survival strategy because these risks are so intertwined.
That interconnectedness really brings us directly to the actual battlegrounds, the specific high-stakes regulatory domains where regional banks are feeling the most heat. Yeah. Let's start with financial crime, specifically AML/BSA modernization. What are the core challenges here, and what happens when banks fall short? It seems like this is always in the headlines.
It is, and anti-money laundering and the Bank Secrecy Act remain paramount concerns for regulators. The AML Act of 2020 really ushered in a new era, demanding more sophisticated tech and more proactive measures. But many regional banks are, frankly, struggling significantly. They're often hobbled by outdated legacy systems that just can't communicate with each other, poor data quality across disparate sources, and fragmented monitoring processes. And what's truly shocking about this, when you dig into it, is the sheer inefficiency it creates. These deficiencies lead to an overwhelming volume of false positive alerts. The report cites rates often as high as 90–95%. Think about that for a moment.
90 to 95%.
Yeah. You've got highly skilled analysts, and 9 times out of 10, maybe even more, they're chasing a ghost. This consumes immense human resources, and even more dangerously, it can obscure genuine criminal activity amidst all the noise. The penalties for failure are severe, as we've seen in cases like Four Oaks Bank and Trust Company, where the breakdowns really stemmed from fundamental weaknesses in controls and monitoring across their entire operation. It wasn't just one thing.
90 to 95%. False positives.
Yeah.
It's just mind-boggling inefficiency. Imagine the waste of talent, the waste of budget, just chasing ghosts, like you said. So, okay, what about fair lending and this concept of digital redlining? We hear about redlining historically, of course, but how does it manifest today, especially with AI involved? And what are regulators doing about it?
Right. The Department of Justice and the CFPB launched their Combating Redlining initiative back in 2021, and recent enforcement actions show they're scrutinizing, well, everything. From the geographic placement of branches and loan officer locations, to marketing efforts in minority-majority neighborhoods, and looking for statistically significant disparities in loan data. What's particularly challenging now and really new is the emergence of this digital redlining from AI algorithms. Regulators are deeply concerned that AI models, if they're not properly governed and validated, can inadvertently inherit and then amplify historical biases that are present in their training data.
So the data itself is the problem source.
It can be, exactly. And this can lead to discriminatory outcomes that violate foundational laws like the Equal Credit Opportunity Act, ECOA, and the Fair Housing Act, FH Act. And this can happen even without any explicit discriminatory intent coded into the algorithm. It places a huge premium on a bank's ability to ensure fairness and, crucially, the explainability of its automated lending systems. You have to be able to show why the decision was made.
That's a critical new risk. The data feeding the AI could be biased, leading to unfair outcomes that are incredibly difficult to detect without the right tools and governance. Okay, what about data privacy and security? Banks are custodians of so much sensitive information, and cyber threats seem absolutely relentless these days.
Absolutely. Banks are prime targets, no question about it. They're targets for sophisticated cyber attacks precisely because they hold vast amounts of sensitive financial and personal data. And on top of that threat, they face an increasingly complex web of data privacy regulations. In the US, there's no single federal privacy law, right? So banks have to navigate this patchwork of state laws like the California Consumer Privacy Act, CCPA, alongside federal ones like the Gramm-Leach-Bliley Act, GLBA, which governs how financial institutions handle customer information. And if they have any European customers, then the EU's GDPR, with its really stringent requirements for data handling and breach notification, comes into play, often with extraterritorial reach. And it's getting even more complex. The CFPB is proposing rules to classify data brokers as consumer reporting agencies under the Fair Credit Reporting Act, FCRA. That could further restrict how consumer data can be shared and used. It's a moving target.
So it's not just about protecting data from bad actors anymore, but also navigating this maze of different, often overlapping rules about how data can even be used and shared legally. And finally, operational resilience. You mentioned the EU's DORO setting a new global benchmark. What does operational resilience actually mean beyond just, disaster recovery? And why is it so critical now?
Yeah, it's definitely a top tier priority now, especially given how dependent banks are on technology and third-party vendors for their core services. Regulators define operational resilience as a bank's holistic ability to prepare for, adapt to, withstand, and recover from disruptions, whatever they might be. Cyber attacks, technology failures, even external events like pandemics. The crucial shift here is moving beyond simply recovering from a disaster to ensuring the continuity of critical business services during a disruption. Can you keep essential functions running? The EU's Digital Operational Resilience Act, DORA, takes full effect in January 2025. It sets uniform, really demanding requirements for ICT risk management, incident reporting, comprehensive resilience testing, the works. And U.S. regulators are watching DORA very, very closely. They're likely to emulate its principles, making it sort of a nascent global standard in the making for operational readiness. It's coming.
Okay, if we connect this back to the bigger picture, all these battlegrounds, AML, fair lending, data privacy, operational resilience, they're not isolated islands. The report provides a fascinating synthesis, showing how each one impacts a bank's operations, its data ecosystem, its technology, and its people. Can you give us a sense of that interconnectedness? Why does it demand this truly holistic response you keep mentioning?
Certainly. Let's take AML BSA modernization again as an example. Operationally, it requires real-time transaction monitoring. That means your workflows need to be agile, probably automated. This, in turn, absolutely needs high-quality data to reduce those overwhelming false positives we talked about, which means your data ecosystem has to be robust, with clear data lineage knowing where the data came from. Technologically, it means moving away from those outdated rule-based systems towards AML platforms that can handle vast data volumes and spot complex patterns. And for your people, it demands compliance analysts who have advanced data analytics skills, who can actually interpret the nuanced output of these new sophisticated systems, not just clear alerts.
So it ripples through everything.
Exactly. And similarly for fair lending, right? You might redesign your loan origination workflows to be more transparent, but this relies heavily on having unbiased training data for your AI models, and it requires that imperative for explainable AI in your technology stack we discussed. Your people need to be skilled in bias detection and model validation. Every single one of these regulatory battlegrounds forces an integrated response because their impacts just spill across all areas of the bank. A weakness in one area, say poor data quality, directly undermines your technology's ability to detect risks effectively. It burdens your operations with immense manual work, chasing false leads, and ultimately it exhausts your people. It truly necessitates a holistic, integrated approach for a bank's survival, let alone success, in this modern compliance crucible.
Okay. So with that incredible interconnectedness really laid bare, let's turn to what the report calls the bedrock, the data ecosystem. It says data is the central nervous system of a regional bank. What does that actually mean in practice, and why is it so fundamental?
It means that every single thing a bank does, every transaction, every customer interaction, every single risk decision generates data. Lots of it.
Yeah.
And the ability to effectively manage that data, protect it, and crucially derive real intelligence from it, that's no longer just a back office task or a nice to have. It's a fundamental prerequisite for building a resilient and truly effective compliance program in today's world. Without a fortified, well-managed data ecosystem, banks are just trapped. They're stuck in this vicious cycle where poor, fragmented data feeds inefficient legacy systems, which inevitably leads to those overwhelming false positives, miss risks, and it obscures genuine threats. It is quite literally the foundation upon which everything else, modern compliance systems, AI, strategic decision-making, must be built. No data, no progress.
Right, the foundation. And this leads us directly to the imperative of data governance, moving from what sounds like data chaos to actual control. What are the core components of an effective data governance framework? What does a bank actually need to put in place to ensure this foundational strength?
Yeah, achieving that control requires a robust data governance framework. It's absolutely essential. It's really a comprehensive set of policies, processes, standards, controls, everything you need to manage data as a strategic asset throughout its entire life cycle, from its initial collection and storage, through its use and protection, and ultimately to its secure archiving or deletion. Some key components include, first, clear ownership and stewardship. You need explicit accountability. Who owns this data? Who's responsible for its quality, its security, its compliance? This means assigning data stewards who are responsible for defining data elements, monitoring quality, and enforcing policies specific to their data domains.
Okay, so clear roles. What else?
Second, comprehensive policies and procedures. This means meticulously documented policies. Things like data classification, distinguishing sensitive from non-sensitive data, clear access controls, who can see what. Also, retention schedules, how long do you keep it, and secure disposition protocols, how do you get rid of it safely. These are absolutely vital for complying with that mosaic of regulations like GDPR and TCPA.
Makes sense. Document everything.
Third, data quality management. This is huge because, as we always say, garbage in, garbage out is a harsh truth, especially for compliance systems. Poor data quality inevitably leads to inaccurate risk assessments, flawed reports, ineffective fraud detection, you name it. A mature program involves continuous processes, profiling the data, cleansing it, validating it, monitoring it to ensure it's accurate, complete, and reliable over time. And the report highlights the quantifiable impact of neglecting this. The average annual cost of poor data quality to businesses is estimated at a staggering $12.9 million.
$12.9 million just from bad data. Wow. Okay, what's the last piece?
Finally, data lineage and metadata management. Banks have to be able to demonstrate the cradle-to-grave traceability of their critical data. They need to know exactly where it came from, how it's been transformed as it moves through different systems, and its ultimate use in reports or models. This is critical for, say, AML investigations, where you absolutely need to trust the source and the context of an alert. Metadata, which is essentially data about the data, and having a centralized data catalog are what enable this crucial traceability. It lets you follow the data's journey.
Okay, ownership, policies, quality, and lineage metadata. Got it. So the report uses this analogy. Data governance is like the bank's immune system. Its benefits might seem passive when things are stable, but it becomes absolutely crucial during a crisis, right? Like a cyber breach or a tough regulatory inquiry. How does good data governance actually perform under that kind of pressure?
That's a perfect analogy, I think. Its benefits might seem sort of passive or behind the scenes during periods of stability, but it's absolutely crucial in a crisis. When a bank can genuinely trust its own data because it's well governed, it can act quickly and accurately. It can identify the scope of a breach faster, it can provide precise, verifiable information to regulators when they ask, and it can recover its operations more effectively. Conversely, an institution with poor data governance is effectively flying blind when it gets hit by a cyber attack or faces a sudden regulatory demand. It can't be sure which data is compromised, which reports are accurate, or even where all its critical data resides. This uncertainty paralyzes the response, it multiplies the damage, and it severely erodes trust with customers and regulators alike. And regulators know this. Those behind the EU's DORA, for example, are explicitly linking operational resilience requirements with robust data protection standards like GDPR, making strong data governance a board-level imperative, not just some IT task anymore.
Okay, so with that strong data foundation hopefully in place, how does a bank then move to actually harness data analytics for proactive risk management? It sounds like a significant shift, moving away from that reactive, almost defensive compliance posture to something much more intelligent and maybe forward-looking.
Exactly, that's the goal. With well-governed, high-quality data as the foundation, banks can truly make that transition. Away from reactive check-the-box compliance towards a proactive, intelligence-driven approach. And regulators are increasingly expecting this. They want banks to demonstrate a deep, data-driven understanding of their own specific risk profiles rather than just producing static reports. This happens in several key ways, key transformations. First, dynamic risk assessment. Instead of those static, maybe annual, point-in-time assessments, data analytics allows for continuous analysis of vast data sets. Customer information, transaction histories, maybe even external market data. This allows you to build sophisticated predictive models. In financial crime, for example, this means developing real-time, evolving customer risk profiles, which are much more accurate and adaptable than older, static models that quickly become outdated.
So it's alive, constantly updating.
Precisely. Second, intelligent transaction monitoring. This directly attacks that needle in a haystack problem we discussed with AML false positives. Data analytics allows for much more precise, context-aware monitoring scenarios that can dramatically reduce those false positives. This frees up your valuable staff for the genuine threats. And AI can identify hidden, complex patterns in transactions, maybe subtle links between accounts that are completely invisible to simple rule-based systems.
Finding the patterns humans might miss. Okay, what else?
And third, systematic compliance gap analysis. You can actually use analytics internally, almost like an internal audit tool, to continuously audit your own compliance ecosystem. This means identifying vulnerabilities proactively, things like inconsistencies in data classification, maybe access control gaps, or broken data lineage paths, and then fixing them before regulators ever discover them. It's about being 2 steps ahead, rather than constantly reacting to findings.
That makes a lot of sense, finding your own problems first. But it sounds like many banks are really caught in this vicious cycle you mentioned earlier, between their old legacy technology and their poor data. Is that truly the biggest hurdle preventing this shift? And if so, how do they even begin to untangle something so ingrained? It sounds daunting.
It is absolutely one of the most significant hurdles, maybe the biggest for many. Outdated, siloed legacy systems are often a primary source of that fragmented, low-quality data. Then, when this dirty data is fed into compliance systems, which themselves might be legacy systems, it inevitably produces unreliable outputs. Hence those massive false positive rates we discussed in AML. Then, the immense manual effort required to investigate all these false alerts consumes the time and budget of the very people who should be focused on fixing the root cause, the underlying data and systems.
So they're stuck putting out fires instead of fixing the leaky pipes.
Exactly. It's this operational drag that prevents the bank from investing in and adopting the more advanced AI and analytics tools, which crucially, absolutely require clean, well-governed data to function effectively in the first place. The institution becomes locked in this high-cost, high-risk, and deeply inefficient state. Breaking this cycle requires a strategic, top-down decision from leadership. They have to commit to investing in data governance and systems modernization in tandem. You can't truly succeed with one without the other. They are fundamentally interdependent.
That's such a crucial connection. Data governance and systems modernization really have to go hand in hand. It perfectly frames technology not as some luxury add-on, but as a non-negotiable part of modern compliance. Why is tech so absolutely vital now? Can banks survive without embracing it?
Well, the simple truth is no, not really. Not in the long run. The sheer volume, the velocity, the complexity of regulations and financial data have just exploded. They've far surpassed human and manual limits. AI, generative AI, specialized regulatory technology, RegTech, they're no longer discretionary upgrades. They are foundational enablers for a sustainable, effective, and frankly, future-proof compliance function. However, and this is a big however, it's vital to acknowledge they're not a silver bullet. Their implementation requires strategic planning, rigorous governance, and real ethical oversight to truly deliver on their immense promise, and importantly, to avoid creating entirely new risks in the process.
Right, not a magic wand. So let's get into the specifics of how AI and generative AI are actually automating compliance work. How do these modern systems really compare to the traditional rule-based approaches that banks have relied on for years? It sounds like it must be a night and day difference.
Oh, it truly is a fundamental shift, and understanding this comparison really highlights the strategic value for regional banks. Let's break it down. First, detection method. Traditional systems rely on static, predefined rules. Basically, if X happens, flag it. Simple logic. Modern AML uses sophisticated behavioral analysis, anomaly detection, complex pattern recognition. This means AI can detect subtle, evolving threats and really sophisticated criminal typologies that those simple rules would completely miss.
So much smarter detection. What about the noise?
Right, false positive rate. We've talked about those incredibly high rates, often 90–95% in AML with traditional systems. AML, because it has contextual understanding and learning capabilities, significantly lowers this rate. That drastically reduces the operational burden and frees up your valuable analysts for high-risk, genuine investigations, not chasing shadows.
Okay, that's huge.
Yeah.
How adaptable are they?
Adaptability to new risks. Traditional systems require slow, costly, manual reprogramming every time there's a new regulation or a new criminal typology emerges. ML models, by contrast, can continuously learn from new data. This provides crucial agility to respond quickly to evolving threats and the changing regulatory landscape, much faster.
And reporting. Audit trails.
Reporting and audit trail. Traditional reporting is often manual, fragmented, maybe inconsistent. AI automates much of the report generation, and with the benefit of explainable AI, XAI, which we'll talk more about, it provides transparent, auditable decision logs. This enhances accuracy and provides much more defensible evidence for regulators during examinations.
What about the cost? People always ask about cost.
Operational cost. Traditional systems are notoriously high cost. You've got intensive manual review plus the expensive maintenance of that aging legacy infrastructure. AI systems, while requiring upfront investment, generally lead to a lower total cost of ownership over time. That comes through automation, better scalability, and leveraging more efficient cloud-based models.
And what does this mean for the people doing the work?
Required human input. This is key. Traditional compliance involves huge volumes of low-skilled, repetitive data entry and review tasks. It can be soul-destroying work. AI shifts the human input towards high-skilled oversight, expert judgment, and strategic decision-making. It significantly elevates the compliance professional's role from, say, a data entry clerk to a strategic analyst or investigator. Makes the job better, frankly.
That's a really compelling case for the investment, moving people of the value chain. But beyond just analytics, generative AI, especially these large language models or LLMs, seems like a whole new frontier. How are they specifically being used in compliance workflows, where accuracy and reliability are absolutely paramount? You can't have mistakes here.
No, you really can't. And generative AI offers powerful new capabilities, particularly for automating that knowledge-based compliance work, which often involves processing vast amounts of unstructured text reports, emails, news articles. For example, automated SARSTR generation. Writing a suspicious activity report, narrative, or a suspicious transaction report, STR, is incredibly time-consuming and requires very specific, careful language. Gen AI can ingest all the structured and unstructured data from a case file, investigator notes, emails, transaction details, and draft a coherent, well-structured first draft of that narrative. This can drastically reduce manual writing time and helps ensure consistency across reports, which regulators like.
Okay, drafting reports. What else?
Dynamic policy and procedure management. Keeping internal policies current with the constant deluge of regulatory updates is a huge manual challenge for banks. An AI system can monitor regulatory feeds from agencies like the Fed or the CFPB, analyze new rules, identify specific policy sections that need updating, and even draft revised language for a human compliance expert to review and finalize. Speeds things up immensely.
Like having a tireless research assistant.
Exactly. And another one, enhanced due diligence, EDD, and adverse media screening. LLMs excel at processing vast amounts of public information, news articles, legal filings, sanctions lists, watch lists in seconds. They can use this to identify potential red flags for high-risk customers or third parties during onboarding or periodic reviews. They can quickly read through thousands of documents, identify relevant connections, and provide concise risk summaries, something that might take a human analyst days or even weeks.
Okay, this sounds incredibly promising, almost too good to be true in some ways. But here's where it gets really interesting and maybe a bit scary. The hallucination problem with AI. We've all heard stories about AI just making things up, fabricating incorrect information. For compliance, that's obviously an unacceptable risk. So how does Retrieval-Augmented Generation, or RAG, solve this? The report calls it a game-changing solution.
It truly is game-changing for this specific problem. RG isn't just another chatbot, it's a really sophisticated knowledge retrieval system that's specifically designed to make generative AI safe, auditable, and reliable enough for regulated industries like banking. Here's how it works. When a compliance officer asks a question like, what specific documentation is required for placing a hold on this type of new account, the RE system performs a clever three-step process. Step 1. Retrieve. It doesn't immediately ask the LLM for an answer based on its general knowledge. Instead, it first searches a private curated knowledge base. This is the key. This knowledge base contains only the bank's own trusted internal documents. Up-to-date regulatory texts, internal procedure manuals, verified policies, board minutes, etc. Controlled information.
So it looks internally first, then what?
Step 2. Augment. It retrieves the most relevant passages from these trusted internal documents. This specific verifiable text is then combined with the original question and passed to the LLM, but as additional context. It's like giving the LLM specific homework reading.
Getting it the right material.
Step 3. Generate. The LLM is then explicitly instructed to generate an answer only based on the provided context. This constrains the model. It forces it to act like a highly intelligent reading comprehension and summarization engine, using only the trusted source material. It prevents it from creatively fabricating information or hallucinating answers based on its broader, less reliable training data.
That's brilliant. So it effectively grounds the AI in the bank's own verifiable truth, preventing those dangerous hallucinations. What are the indispensable benefits of this RAG compliance co-pilot approach for regional banks?
The benefits are profound, especially for a regulated entity that's operating under constant scrutiny. First, drastically reduces hallucinations. By grounding every answer in specific, verifiable source text from the bank's own knowledge base, it virtually eliminates the risk of inaccurate or fabricated compliance guidance. This builds essential trust in the system. Second, provides auditability and traceability. This is absolutely critical for compliance. A well-designed RAG system can cite its sources. It can point directly to the exact document, page, and even paragraph from the internal knowledge base that it used to formulate the answer. This creates a clear, defensible audit trail for internal auditors and external examiners. You can show your work.
That's huge for regulators. What else?
Third, ensures information is always current. Unlike standard LLMs, whose knowledge is essentially frozen at their last training date, a RAG system's knowledge is as current as the documents in its dedicated knowledge base. If a regulation changes, you update your internal regulation document, maybe upload the new PDF, and the RAG system's responses are immediately updated. It ensures you're always working with the latest approved information.
That sounds like the strategic path forward then, investing in a robust RAG system coupled with a really well-governed, continuously updated internal knowledge base. But let's talk about the ethical tightrope, as the report calls it. It warns that just deploying AI, even a RAG, can amplify regulatory and reputational risk if it's not governed properly. Algorithmic bias and the need for explainable AI or XAI are big concerns. How exactly does AI perpetuate bias, and what is digital redlining in this context specifically?
Yeah, this is a critical ethical challenge, but perhaps more importantly for banks, it's a significant legal and regulatory challenge. AI models learn from historical data. That's how they work. But if that historical data reflects past societal biases, and often it does, the models will unfortunately learn and potentially perpetuate those biases, even without any explicit programming to do so. This risk is arguably most acute in lending. An AI model trained on historical lending data might, for instance, learn correlations that systematically disadvantage applicants from certain racial or ethnic groups or specific neighborhoods. Even if race or geography isn't an explicit input variable, this is what regulators mean by digital redlining, and it's a major enforcement priority for the Department of Justice and the CFPB because it violates laws like the Equal Credit Opportunity Act. And bias can also subtly surface in other areas like fraud detection models, potentially unfairly flagging certain demographics based on patterns learned from past, potentially biased data.
So it's not just about what the AI does, but why it does it, especially when critical decisions like loan approvals or fraud flags are being made automatically. This brings us directly to the mandate for Explainable AI, XAI. Why is transparency so crucial in this domain? And how does XAI actually work? What does it do?
Transparency is absolutely demanded. It's demanded by regulators and increasingly by customers, too. People want to understand AI decisions that impact their lives. XAI comprises a whole suite of techniques and methodologies designed to make those black box AI models where the internal workings are complex and opaque, understandable to humans. And it's not merely a nice to have. In many cases, it's a regulatory requirement. For instance, under EcoA, if an AI model makes an adverse credit decision, denies a loan, the bank must be able to provide specific, intelligible reasons for that decision to the applicant. XAI provides the tools and methods to derive those explanations from the complex model. It's critical because, well, it builds trust with customers, auditors, risk managers. It allows for scrutiny and validation of the model. And crucially, it bridges the communication gap between the highly technical data scientists who build the models and the non-technical risk and compliance professionals who need to understand, oversee, and act on these decisions.
Okay, so it makes the why understandable. And how should banks approach implementing XAI? Are there any established frameworks or best practices that can guide them through this complex area? It sounds hard.
It can be complex, but yes, banks should definitely adopt established frameworks to guide their approach. A leading one highlighted is the NIST AI Risk Management Framework, or AI RMF. It provides a voluntary but very comprehensive structure for managing AI risks throughout the system's entire life cycle. It's organized around 4 core functions: govern, map, measure, and manage, and it translates into practical steps. Conducting regular bias audits using statistical fairness metrics, ensuring your training data is diverse and representative, maintaining robust model documentation, which is often overlooked, and implementing a human-in-the-loop review process for particularly high-risk or sensitive decisions. These are concrete steps banks can take to ensure responsible AI deployment.
Human in the loop, that seems key for critical decisions. Now, it seems like XAI and data governance are really intimately connected. The report says they're two sides of the same coin. What exactly does that mean for a bank trying to navigate these challenges? How do they relate?
It's a crucial connection, almost symbiotic, really. Think of it this way. Explainable AI can provide a technical explanation for a model's decision. It might highlight that, say, a specific zip code or a certain type of transaction was highly influential in a loan denial or a fraud alert. However, that technical explanation can be superficial, maybe even misleading, and certainly insufficient for a regulator without the deeper context that's provided by strong data governance. Data governance, with its emphasis on data lineage and metadata, provides the deeper why. It helps answer critical questions like, okay, the model flagged this zip code, but is this zip code a legitimate, fair proxy for a financial risk factor? Or is it inadvertently acting as a proxy for race, thereby introducing illegal bias?
Ah, I see. The context behind the data point.
Exactly. Without clear data lineage, without understanding how data has been transformed, without the business context provided by robust data governance, a bank cannot truly explain or defend its models to regulators in a comprehensive and defensible way. Therefore, a genuine commitment to explainable AI requires an equal foundational commitment to the ongoing, often unglamorous work of data governance. They truly work in tandem. One explains the what, the other explains the why.
Okay, so we've covered the unrelenting pressures, the absolute necessity of the data foundation as the bedrock, and the critical role of technology like AI as the enabler. Now, let's tie it all together, actually re-engineering the bank itself. The report highlights legacy technology as the single greatest impediment to agility and effective compliance. What are the specific problems with these outdated systems that are really holding regional banks back in this compliance crucible?
Yeah, those legacy systems, often built on monolithic architectures from decades past, they are indeed a significant source of risk and also immense cost for many regional banks. They are notoriously expensive just to maintain. The report suggests it can consume up to 64% of a typical bank's IT budget, just keeping the lights on for the old stuff. That absolutely stifles any budget for innovation.
54%. Just maintenance.
It's a huge number. And they create these pervasive data silos we keep talking about, making it almost impossible to get a unified, holistic view of risk across the entire institution. Their inherent inflexibility makes adapting to new, rapidly changing regulations incredibly slow, extremely costly, and really prone to errors. Furthermore, their outdated security protocols often create significant vulnerabilities, making them potential single points of failure in an increasingly hostile cyber landscape. It's just a foundational drag on the entire institution's ability to compete and comply.
Okay, so rip and replace sounds like a dream for some IT folks, maybe just tear it all out and start fresh. But the report says that's often too disruptive for a live operating bank. So what's the viable path forward for modernization, and what does this idea of embedded compliance actually look like in practice in this modernized environment?
Right, rip and replace is usually too risky and disruptive. The more viable and pragmatic path is what the report calls progressive modernization. This involves a phased transition, moving away from those monolithic core systems towards a more modular, API-driven, and often cloud-native architecture. This allows banks to incrementally modernize their critical functions, maybe targeting the highest risk or least efficient systems first, while crucially maintaining business continuity. You do it piece by piece. And the ultimate goal, as you mentioned, is achieving embedded compliance. In the past, compliance was often bolted on. It was an after-the-fact review or a separate check performed by a different team.
Yeah, the compliance department slowing things down.
Exactly, that perception. With modernization and APIs, compliance can be built in as automated, reusable services. For example, instead of a manual Know Your Customer (KYC) check performed by a separate team after an account application is submitted, a modern workflow simply calls a KYC compliance service via an API as an integrated real-time step during the onboarding process itself. This makes compliance a real-time function, it automates the checks, dramatically reduces errors, ensures consistency, and it truly transforms compliance from being perceived as a bottleneck into a seamless, automated part of operations. Which, ironically perhaps, enables greater business agility and faster time to market for new products because compliance is already handled.
It's a profound shift. Compliance moving from bottleneck to potentially a business accelerator. But this isn't just about the technology stack, is it? It also requires a profound transformation of the workforce, what the report calls the human element. What does the next generation of compliance talent actually look like? What new skills are needed for these sort of hybrid professionals?
You're absolutely right. Technology alone cannot solve these challenges. You need the right people interpreting it, governing it, using it. The compliance professional of the future is no longer just a rules expert or a checker. They are becoming a true hybrid professional. They need to be part legal regulatory expert, part data analyst, part technology strategist, and increasingly part business advisor. Their required skill set is evolving significantly. While deep regulatory knowledge is obviously still vital, it's now more about understanding the intent behind the regulations and being able to map those rules to complex business processes and data flows.
So less rote memorization, more application.
Exactly. They need hands-on data querying and interpretation skills, not just passively reviewing pre-made reports. Proficiency with AI and ML tools, understanding conceptually how things like ORAG and XAI work, is becoming essential, moving way beyond just basic office software. Risk management itself shifts from just historical review towards more proactive, predictive modeling, and critically, having the skills to assess things like algorithmic bias. And communication isn't just writing internal memos anymore. It's about effectively explaining complex technical and regulatory issues to the board, collaborating seamlessly with data scientists and IT folks who speak a different language, and strategically influencing business decisions. And this shift in required capability extends all the way to the top of the compliance function.
So following that, the role of the Chief Compliance Officer, the CCO, must also be undergoing a pretty profound evolution. They can't just be the no person anymore.
Absolutely. The CCO's role is undergoing perhaps the most profound evolution. No longer confined to a purely oversight function that merely reacts to problems or flags violations after the fact. The modern CCO is expected to be a strategic partner to the CEO and the board. Full stop. They are now expected to provide critical input on core corporate strategy, on significant technology investments, on new product development, even on merger and acquisition activity. Their role is increasingly to ensure that compliance and risk considerations are embedded proactively right from the very outset of any new initiative, not as an afterthought. This elevated role demands a CCO who is not only an impeccable regulatory expert, but also deeply tech-savvy and commercially business-minded. It's a tough combination to find.
That's a significant shift in expectations, needing that strategic tech and business acumen altogether. And I imagine finding and then training people with these highly specialized hybrid skills is a monumental challenge, especially for regional banks that might not have the resources of the giants.
It is indeed a significant talent challenge.
Yeah.
The financial services industry already faces issues with high employee turnover and burnout in traditional, often reactive and burdensome compliance roles. The specialized hybrid skills needed for modern compliance, that blend of data analytics, AI literacy, cybersecurity understanding, strategic thinking, they're scarce in the market, and the competition for this talent is fierce. Regional banks really need a dual strategy here. First, they have to invest heavily in upskilling and reskilling their existing teams, provide formal training, certifications, opportunities to learn on the job, and simultaneously, they need to create clear, compelling career paths and attractive work environments to recruit and, crucially, retain new talent with these skills. Make compliance an exciting place to work again. And automation and AI, perhaps paradoxically, can actually help with the retention piece. By automating the mundane, repetitive tasks, you make the compliance roles more engaging, more analytical, more strategic. It allows your human experts to focus on complex investigations, strategic analysis, and proactive risk identification, the interesting stuff which improves job satisfaction and reduces burnout.
Using tech to make the human jobs better, not just replace them. That's key. Now, what's fascinating here is how often these integrated elements, people, process, tech, break down in the real world. The report provides some powerful lessons from the field, starting with some cautionary tales, looking at the roots of failure. It points out that failures are rarely isolated errors. They're almost always systemic breakdowns. Can you give us some examples that illustrate this?
Yeah, these case studies are incredibly insightful because they reveal these recurring patterns of systemic failure. If you look back at the bank failures between 2008 and 2011, the Government Accountability Office, GAO, analyzed them pretty thoroughly. The root causes were systemic, hitting all pillars. They found issues like an overly aggressive growth strategy that's a flawed process, weak underwriting standards, a breakdown in both process and people, risky deposit practices, another process issue, and fundamentally, a failure of management and board oversight, definitely a people issue. And critically, the technology to adequately monitor these rapidly growing high-risk loan portfolios was often lacking or outdated, completing that dangerous trifecta.
So all three pillars were weak.
Often, yes. Or look at more recent AML consent orders against regional banks for anti-money laundering deficiencies. They consistently show similar systemic weaknesses. Things like inadequate board oversight, a people issue, deficient risk assessments and internal controls indicating a breakdown in process, and critically, a failure to properly validate, resource, and tune their monitoring systems, highlighting failures in both technology and the people overseeing it.
Seeing a pattern here.
Exactly. And fair lending enforcement actions, like the Department of Justice redlining cases, they consistently highlight a failure to integrate operational decisions like where they put branches, where loan officers are located, how they market products with core fair lending principles. This failure in process and people alignment invariably leads to statistical disparities that are identifiable through data analysis, pointing to failures in data management and the application of technology to monitor for fairness. The consistent theme across all these examples is crystal clear. A weakness in one pillar, whether it's leadership strategy, people, an outdated process, or inadequate technology, inevitably exposes and breaks the others. It underscores why a holistic, integrated compliance framework isn't just ideal, it's an absolute essential for resilience, let alone survival, in this compliance crucible.
So it's really not just about one bad apple spoiling the bunch. It's truly the whole barrel people, process, tech that needs to be sound. But there are also success stories, mentioned paths to modernization that regional banks have successfully navigated. What can we learn from banks that seem to be getting this right? What do they do differently?
These success stories are encouraging, and they all underscore the immense value of taking an integrated, strategic approach, not just a tactical one. For instance, one cloud modernization story. A regional bank's strategic move to the cloud wasn't just framed as an IT upgrade. It was positioned and executed as an operational transformation. It eliminated an entire department's manual workload. They successfully migrated $16 billion in assets, and they made their daily processing 20% faster. That delivered tangible improvements in both efficiency and operational resilience.
Real business impact.
Absolutely. Another example involved a data platform implementation. A regional bank found success with a modern data platform, like a Databricks Lakehouse. This wasn't solely about the technology itself. It critically addressed the people element, too. Technically, it broke down those frustrating data silos. But operationally, it empowered business teams with self-service analytics, giving them direct access to insights without waiting for IT. Interestingly, their biggest challenge wasn't reported as technical, but cultural. Managing the change, teaching employees new, more collaborative ways to work with data, investing in the people side.
Culture change is always the hardest part.
Always. And a third example, a digital-first expansion. A super-regional bank managed to achieve remarkable growth, with its new branches expanding 5 times faster than historical rates. They did this by deliberately coupling an ambitious digital product strategy with a robust, customized risk management platform built alongside it. This clearly demonstrates that innovation and growth can be safely pursued, even aggressively, when they're supported by the right enabling technology and an integrated risk management framework from the start.
What's really striking here, listening to these successes, is that the critical lesson doesn't seem to be just about picking the right software. Modernization, it sounds like, is fundamentally a cultural and operational shift, maybe even more than it is an IT project. It sounds like those people and process costs are just as important, maybe more so, than the software licenses themselves.
That's exactly right. That's a key takeaway. Any transformation budget and the associated planning must allocate significant resources, time, money, attention, not just to the software licenses or the hardware, but crucially, to comprehensive change management, to thoughtful process redesign, how will people actually work differently, and to thorough ongoing employee training and support. Those people and process costs and the dedicated effort required for them are, in many ways, as important, if not more important, than the technology investments themselves. Neglecting them is almost always a recipe for failure. Even if you buy the best tech in the world, it just won't stick.
Okay, so for regional bank leadership listening to this, it's clear this isn't a single project with a neat start and end date. It sounds like a continuous multi-year journey. The report outlines a phased approach to this compliance transformation. Can you walk us through those phases? How do they help make this massive undertaking more manageable, allow for learning, and build momentum along the way?
Yes, that phased approach is absolutely crucial for managing the inherent complexity and risk involved here. It allows for more manageable chunks of investment, provides opportunities for iterative learning, seeing what works and adjusting, and, importantly, helps demonstrate early wins to build momentum and secure continued buy-in from across the organization. It breaks it down. Phase 1. Foundational governance and assessment. This is typically year 1. The main objective here is really to establish control and create a comprehensive baseline understanding of where you are. Key actions include forming a cross-functional compliance and technology transformation council. Critically, this needs CEO sponsorship and should bring together the CCO, CIO, CRO, and key business line leaders. It can't just be compliance or IT alone. Then, conduct an enterprise-wide risk assessment, really mapping regulations to your specific processes, data flows, and supporting systems. Where are the biggest gaps? This phase also involves launching a formal data governance program. You might focus initially on defining critical data elements, especially for high-risk areas like AML and fair lending, establish clear data ownership, create a preliminary data catalog, and simultaneously audit your key legacy systems. Identify the highest risk ones, map their compliance dependencies, understand their true maintenance costs, and assess their security vulnerabilities. Get the lay of the land.
Okay, so phase 1 is about assessment and getting organized. What happens in phase 2?
Phase 2, targeted modernization and automation. This might span years 2 and 3. The objective here is to start actively remediating those high-priority risks you identified in phase 1 and begin realizing some tangible efficiency gains. Show some progress. Key actions involve that progressive modernization of the highest risk legacy systems, particularly in areas like AML transaction monitoring or maybe loan origination, moving them towards more modular, API-first architectures. You'd also deploy foundational right tech solutions, things like automated regulatory reporting tools, digital identity verification, maybe policy management software. Get some quick wins with targeted tech. And critically, begin deploying data analytics more broadly for risk detection, maybe specifically targeting false positive reduction in AML, and incorporating data skills into talent training. This phase requires a significant investment in upskilling your existing team's formal training, certifications in data analytics, AI literacy, basic cybersecurity awareness, building internal capability.
So phase 2 is about fixing the biggest problems and starting to automate. What's the final phase?
Phase 3. Advanced intelligence and embedded compliance. This might be years 4 and 5, maybe ongoing. This is where you achieve that truly transformative state. Proactive, intelligent, and deeply embedded compliance that actually starts contributing to competitive advantage. Key actions here include deploying those AI co-pilots, like the RG-based systems we discussed, to provide real-time auditable compliance guidance across the organization, empowering frontline staff. You'd implement robust explainable AI, XAI practices, and mature model governance frameworks for all your AM models, ensuring continuous monitoring for fairness, accuracy, and drift. The goal here is to move towards compliance as a service, COF, where core compliance functions are abstracted as simple, reusable, API callable services that can be seamlessly embedded into new product launches or business processes from day one. And finally, this phase is about truly cultivating a pervasive culture of compliance where risk ownership is genuinely embraced by the first line of defense, the business units, powerfully supported, not policed, by the second line, compliance and risk.
Call us compliance as a service. That's a powerful concept. So that's a clear, albeit ambitious, roadmap. But securing that kind of multi-year investment always comes down to the business case, right? How do leaders effectively build that case? How do they move beyond just talking about simple cost avoidance and truly demonstrate a compelling return on investment, ROI, for this kind of fundamental compliance modernization?
This is absolutely critical for getting executive buy-in and ultimately board approval for such a significant multi-year program. The ROI case needs to be structured clearly and measure benefits across three distinct categories, illustrating both the defensive value, avoiding bad things, and the offensive value, enabling good things. First, risk reduction, cost avoidance. This is the traditional justification, but it needs to be quantified, not just asserted. You need to quantify the potential cost of not doing this. Look at potential regulatory fines by analyzing recent peer enforcement actions. A single redlining settlement can easily exceed $9 million. Major AML failures can incur penalties in the tens or even hundreds of millions. Put real numbers on it. Then there are the massive remediation costs if you get hit with an order. The expenses for external consultants, legal fees, diverting vast internal resources for multi-year remediation plans. These are huge hidden costs. And of course, the harder to quantify but very real reputational damage, which directly impacts customer trust, market share, and ultimately the bank's stock price.
Okay, so quantify the downside avoidance. What's the next category?
Second, operational efficiency, direct cost savings. This is where you show direct, measurable savings hitting the bottom line. Quantify the reduction in manual effort. Automating regulatory reporting, for example, can save hundreds, maybe thousands of person hours annually across the team. Reducing AML false positives by, say, 70–80% frees up those highly skilled investigators for higher value work instead of just chasing ghosts. Calculate that value. You'll also see demonstrably lower IT maintenance costs from decommissioning those expensive, clunky legacy systems. Modernizing core systems can reduce overall operational IT costs by 30–40% or more over time. And having clean data and automated processes significantly reduces the time, effort, and therefore the cost associated with both regulatory examinations and internal audits. Smoother audits save money.
Makes sense. Hard dollar savings. What's the third, more forward-looking piece?
Third, strategic agility, value creation. This is often the most compelling, forward-looking, and potentially impactful component, though maybe harder to quantify precisely up front. Embedded compliance, as we discussed, can drastically reduce new product launch timelines. A process that might have taken 9 months due to manual compliance checks could potentially be reduced to just 4 weeks if compliance is automated via APIs. That allows the bank to respond far faster to market opportunities, beating competitors.
Speed to market is huge.
Huge. And streamlined digital-first processes for things like customer onboarding or loan applications enabled by this modernization lead to significantly higher customer satisfaction and better conversion rates. The report suggests conversion rates could potentially increase from an average of maybe 15% to 50% or more in some digital channels. That's direct revenue impact. And finally, having a robust integrated data ecosystem provides much higher quality, timelier data, not just for compliance, but for superior strategic decision-making across the bank, from optimized credit risk assessment to more informed market expansion strategies. Better data leads to better business. So these aren't just cost savings, they are potential engines for growth and competitive advantage.
Okay, putting it all together then, what does this all mean for regional banks caught in this compliance crucible? It sounds incredibly daunting, a huge amount of pressure and work, but you're also saying it's potentially an unprecedented opportunity.
Absolutely. That's the core message, I think. The powerful forces reshaping banking right now, that unrelenting digitalization, the heightened geopolitical risk, the escalating regulatory intensity, they present regional banks with their really stark, almost existential choice. Continuing down the path of patchwork fixes, maintaining siloed systems, relying heavily on manual processes. That path inevitably leads to spiraling costs, escalating risks, and ultimately diminishing relevance in the market. The alternative, the path forward highlighted in this report, is a strategic, deliberate transformation, one that fully recognizes and embraces the profound and unbreakable interdependence of an institution's people, its operational processes, and its data and technology ecosystem. An institution that truly masters this transformation won't just comply better with regulations, it will become inherently more resilient, more agile, more efficient, and more intelligent overall. And this leads directly to better products for customers, smarter and faster internal decisions, and a vastly superior customer experience. The compliance created can definitely be a source of immense pressure. Yes, absolutely. But for those banks willing to lean into it, to embrace the change strategically, it's also a powerful engine for forging a more sustainable, competitive, and ultimately profitable future.
So as you, our listener, think about the future of finance, consider this. How might a bank's willingness or unwillingness to embrace data as its true bedrock and AI as its trusted co-pilot fundamentally reshape its relationship with both risk and opportunity, potentially transforming its very DNA for the decades ahead? This has been The Deep Dive.